This is Clay Nichols with an overview of a company called Medifast, which I invested in a few weeks ago, and still looks like a very good value proposition. So I'll be covering my philosophy, the disclaimer that this is not investment advice, overview of Medifast, their chief competition, and then detailed data and some risks, and then questions, information that I would like. And I will be updating, posting updated videos, or planning to, in the future with updated numbers. So I'm putting the numbers kind of at the end of this. Okay, so first of all, my philosophy, I want to be confident in my valuation of the stock. If Mr. Market drops the price by 15% and nothing changes in the fundamentals, I want to be confident that I can buy more or certainly not sell. I think the S&P 500 is overvalued. I may do a video on that later, but I've done some quick calculations, and 25% of the total dollar gains for 2021 were from Google and Microsoft, which gained, and Google appears twice in the, has two different classes of stock, or two different companies. Alphabet, and I forget what the other one is called, and it gained roughly 60% in each of those, and Microsoft gained about 50%. If you add in Apple and NVIDIA, then we're up to a total of 5 companies, counting Google twice, and that accounts for 36% of the gains. So if of the roughly 30% stock market gain in the S&P 500 in 2021, a fourth of that was just 2 companies, and nearly a third of all of that was just 5 companies. So I think the S&P 500 is overvalued. Normally, I would just put my money in the S&P 500, and if I can't do significantly better, it's not worth the effort. However, I don't feel safe doing that. So some of my money is in the S&P 500, and some of it is in individual stocks that I've picked. Okay, I'm not a momentum investor, but I recognize that many people are. And so what that can do is push stocks past their fair valuation, as people keep bidding up a stock and saying, hey, it's going up, throw money in it. And then it goes up even more. And then other people say, it's going up, let's put more money in. But that can only happen so long. But it can also push stocks below their fair valuation. And while I don't want to chase a stock that has gone above its fair valuation, if it's gone below its fair valuation, maybe I want to take a look at it and see if it's a good deal, if it's a good company at a good price. So I'm looking for good stocks that were beaten down by an overcorrection, and I think I've found one. I've looked at several that had their price down for the last 6 to 12 months, and looked at, of those, 1 or 2 of them looked like they were actually good companies, and now below a fair price for that company. And then what I did is I waited for Medifast to start recovering, and hopefully it's out of the woods now. It's up a little bit from where I bought it, but even if not, I feel like I've gotten it at a good price. So, and then I'm going to determine the value of the stock. Okay, disclaimer: this is not investing advice. This is for educational purposes only. I'm long on Medifast. Okay, let's jump right into the overview. So they address the pain of obesity with weight loss coaching and mail order meals. And that's where they make their money, primarily actually off of the mail order meals. The coaching is just more of a means to an end to help that be successful. It's a direct-to-consumer market business model, so they're selling through the coaches, which are usually former customers. There's increasing demand for this. Obesity is increasing in the U.S. There are many factors for this. I won't go into it. Lifestyle, the high fructose corn syrup, name your poison. We evolved to like the taste of sugar and to like to things that will make us fat because it helped us survive, but now we've got too much of a good thing. So here is some data from the CDC down here at the bottom. You can see the rate of obesity. It's obviously just one metric, but it gives you an idea. This is a long-term trend. It's leveled out a little bit in 2020, probably because of the pandemic, but I suspect that'll come back. And we'll talk a bit about internet search trends on diet plan and these companies, just to give you an idea of maybe forward-looking or near forward-looking marketing outlooks for our people looking for these solutions. Okay, it's got a pretty significant moat, in my opinion, the coaches. They're usually former customers. They have a ready supply of coaches who are also doing the marketing for them, and they're paid for results. And they've been growing revenue per coach, and we'll get into that in a minute. And they're also subscription-based, as I said, direct to customer. They're running a direct client model with 100% of their products shipped to clients. 90% of the revenue is subscription-based, which is great. That gives us predictable revenue. 90% of the coaches started out as clients. And an old joke in marketing, which I've done a fair amount of, my background is, by the way, is running a software company for a little bit over 20 years. So that's what gives me maybe some insight into how businesses run and what makes a successful business. And subscription revenues have been the holy grail for lots of companies. Everybody's as much as they can moving towards that, predictable revenue, et cetera. And the old joke in marketing is that half your marketing dollars are wasted. Problem is you never know what half. So the beauty is by paying their coaches for performance, then they're encouraging their coaches to go out and do marketing and sales. But the half of the coaches who don't do it right for whatever reason, maybe they're not good at it, they just know what they're doing, they just weren't lucky, they don't pay for that. They only pay when the coaches produce results, which is fantastic from a business standpoint. Okay. So let's jump down here to chief competition. I'm going to just go very briefly over this. Weight Watchers is probably their primary competition. I looked up some of the other ones. I think it was Nutrisystems is actually not listed, if it's the one I'm thinking of, on the NASDAQ anymore, or its stock isn't listed. So looks like Weight Watchers is the biggie here. However, their revenue, earnings, and free cash flow are all down over the last few years. I'm looking here at SimplyWall.st. You can see earnings growth is minus 7%. And you can see since about 2000, end of 2018, beginning of 2019, revenue, sales, revenue, free cash flow, and earnings have all been down. Not good. Okay. So another one is Noom, which is an app-based startup. It's not yet public, as far as I know. Now, I suspect this is a golden child. This is kind of the golden child of a tech startup, and that's made MED less popular. Tech just looks sexier. So their approach is behavior change. So it's all app-based, sort of like, you can think of it maybe as an automated coach, and the idea is to change your behavior. So they aren't supplying meals, so that makes it less expensive, dramatically less expensive. Downsides are that obesity, in my opinion, is a result of very complicated behavior. It's reducing it requires lifestyle changes. I think you need a coach for that. But we'll see what happens. Something to bear in mind is that tech companies have very high fixed costs. People like to think about their incremental costs, the cost to serve the next customer, as being quite low. That's true, but I can tell you, I've run a tech company for 20 years. We have really high startup costs. And you have to reach really high volumes for that all to make sense. They may reach those volumes and they may not. And by definition, a startup means literally that it's an unproven business. Everybody thinks a startup is about making a lot of money. The deal is that the only startups investors will invest in are the startups that are shooting for the moon, because they know that there's risk in all of them. Mine was a very small company. We weren't $1 billion company, but there was still that risk because we were doing something that was a little bit new. Speech therapy software, if you're interested. So software for your grandmother who's had a stroke or brain injury, help her learn how to read and speak again. The biggest impact on MED might be crazy money spending, which I've seen in my industry and others. However, Noom may be competing for or sucking up all the Google ads. If you know what Google ads are, online advertising. When you do a Google search and you see an ad, those are Google ads. You can bid for this. However, MED does not seem to advertise on Google. I did a bunch of diet searches, and I'm only seeing Noom ads, not ads from other companies. Not even ads from Weight Watchers, which suggests maybe Weight Watchers hasn't found that to be a good place to advertise. I looked briefly at Herbalife, but they're really an indirect competitor. They're more supplements. They're also been accused of being a pyramid scheme. I don't know anything about that. I'm disregarding them for now. Just out of curiosity, I looked at search trends for all of these. So in the US for Optavia, which is the newest product launched a couple of years ago from Medifast, Noom, diet plan in general, Weight Watchers. Interestingly, you can see the trend was decreasing over 2021. This doesn't go back further than that, although I could maybe do 2 years. That would be interesting to see. But I think we're seeing the tail end of COVID and restaurants being shut down, people not getting together. Because one of the things with eating is that instead of eating for sustenance, we've learned to eat for other things like social activities. Nothing wrong with that, but decreased social activities means decreased eating. Now it looks like this is rebounding. Very recently, in the last couple of months, it jumped up, came back down again, but it's still up. I suspect we'll see that continuing to come up. Now, bear in mind all of this, that we've seen a decrease in search trends. That's just a surrogate or a proxy for interest in these products. Despite this decreasing trend in searches, which, by the way, is rebounded here at the end, we're still seeing, and we'll get to this in a minute, that Medifast has actually been growing revenue during this whole time. So that's great to see. So in a difficult environment, they've actually thrived, which is really a mark of a good company. Okay, so let's look at some more detailed data. Okay. Outstanding shares are actually decreasing. So they're doing, I'm assuming, some sort of share buyback. You can look here. That's compounded annual growth rate in outstanding shares is -2%. So it's actually gone down over the last 11 years. Now, most of that was about 5 or 6 years ago, although it's still decreasing a little bit. So, but good to know. That's a positive trend. Their PE to growth ratio is very good. It is 0.9. And basically, that's a very rough metric for quickly looking at a company's, not just their current PE ratio, which is the price to earnings, which is what you're paying for every dollar of earnings. So PE ratio, if I say a company's got a PE ratio of 15, it means I'm paying $15 in price for every dollar in earnings. So if they had $1 in earnings, I'm paying a year. They're making $1 in earnings a year. I'm paying $15 a share for that company. And that, by the way, 15 is close to the historic average for the stock market. Their PE is about 15. Their earnings per share growth is about 12%. So they're actually, these numbers are a little bit old. They're doing a little bit better. Some of this data is from about 2 months ago when I first invested in them, or a month ago rather. Okay, now very importantly, I only look at companies where the analyst predictions are accurate, because everything forward-looking is based on predictions from analysts. I know some people calculate their own earnings. I prefer to let the analysts do the work, but then make sure that I'm only looking at companies where the analysts have been accurate most of the time in their predictions. And I do that by using the FastGraphs Analyst Scorecard. And you can see here that the analysts have been very accurate looking out a year. And in fact, I'm going to jump over here to FastGraphs. 1 year forward with a 10% margin of error, 2 years forward with a 20% margin of error. How often did they beat, hit, or miss? So the analysts were very, very accurate. That leads me to believe, and this is going back about 11 years. They only missed 1 year going out one. They only missed one prediction looking out 1 year, and they missed 2 by just a little bit by looking out 2 years. So that tells me the analysts are pretty accurate, and I would expect them to be accurate going forward. No guarantees, obviously, but nice to know. Okay. The earnings per share are looking to grow about 18% per year. This is from Wall Street Zen. You can see that we're looking at 2 analysts here, and they're looking at a 20% growth in earnings next year and 39% over 2 years. So that's about 20% next year and about 18 or 19 the year after, which is fantastic. Okay, they pay a 3% dividend, which is fantastic. Okay, so let's go out and look at FastGraphs. Okay, I'm going to do this live. Okay, so now what FastGraphs does is kind of their bread and butter. They do a number of things, but one thing that's really nice is they look at the historic PE ratio, that's price to earnings ratio, for a stock, okay? And then they look at what the normal PE ratio has been. So in this case, and they calculate that by looking at, well, I won't go into the details of how they calculate that, but the idea is that you'll see that the price tends to fluctuate around this blue line, okay? Blue line goes up. Now, the blue line goes up because earnings went up, okay? So the blue line is always what the price would be relative to the earnings. So in this case, it's always 22.1, right? So that blue line at any given quarter is going to be 22.1 times what the earnings were. So you can see that at one point the price went way up above that valuation, but then it returned. Then it went below. Then it returned. So you can see it kind of oscillates or around that blue line. And then the orange line is what the PE would be if it were equal to the growth rate. So in this case, they've got an earnings growth rate of about 24%. That may be a little bit high. Remember, and different companies pull this data from different places. We were seeing more like an 18% or 19% growth rate. So here's the price, and FastGraphs would say, if everything continues the way it has in the past, we would expect the price to eventually start to adjust back to, instead of being a PE of 15, right? So right now the price is 15.65 times the earnings, right? If it were 22.1 times, then the price would actually be $301. So the FastGraphs folks would tell you they would expect this price eventually to correct back here, to migrate back to that valuation. And that makes sense because that's also in line with the PE to growth ratio. So one thing we want to look at here is free cash flow. So let's go look at free cash flow. Okay. So their dividend has been below free cash flow, except for this spot right here. But it looks like it'll be well covered. And I want to go out also. We're going to look at Simply Wall Street. Looking at Medifast. Okay. And Simply Wall Street says it's trading at 64% below its estimated fair value. They are using a discounted free cash flow method. So they basically look at that free cash flow that we saw in the previous graph and FastGraphs, and they look at all the future cash flows as if it was like an annuity, if you will. And then they do the net present value. And there's a mathematical calculation for that. It's nothing mysterious. And they're estimating our earnings are going to grow at about 16% next year. So it's just a little bit lower than what we were looking at. So we've seen three different numbers for earnings growth: 16%, about 18 or 19%, and 24%. Okay. So I'm going to go down. We were just talking about, so there's just a more graphical representation. They think the fair value is like 572. I think that's a little inflated, but I think it's certainly well above the 203. And you can even go in here and look at the data and it'll show you the free cash flow, etc. Okay, so let's go down here to dividend. Let's see, dividend. Okay. So 2.78%. Stability of payments. Now, what we want to look at here is the actual amount paid per year, because that's been going up steadily. Okay, dividend per share has been going up. They're saying here that it's not a stable dividend because they're looking at it based on relative to the price of the stock. Well, the price of the stock can go up and down. If stock becomes popular, it goes up, goes down. Remember, price is just an auction value. It doesn't tell you what the intrinsic value is. So it's been steadily rising. It's only paid a dividend for 6 years, so good to know. And its dividend is well covered. Okay, which is what we saw from FastGraphs. And future dividend is well covered. Gross profit is up nearly 50%. Trailing 12 months. So we'll look here at Seeking Alpha. Okay, and if we look here at, here we go. So total revenue, you can see what's happened there. Very nice. Gross profit also up. And operating income also up. And you can see trailing 12 months is up about 350 over 700, just doing some back of the napkin math. So that's about almost 50%. 350 divided by 700, about 50%. Just fantastic. Revenues also up about 450, call it 450 divided by about 950, about 45 to 50%. So that is just fantastic. Let's look at everything else. This is nice because it shows it to us as graphs. Interest and investment, and I don't care too much about that. Net. Let's look at net income, everything up and to the right, as we say in startups. I don't usually look at this a lot. I'm more interested in strictly the bottom line numbers, or earnings increasing, cash flow increasing. That tells me mostly what I need to know, but I did want to look over here just really briefly. So profit margin is really good, much better than the median for their sector. That's probably the most interesting number for me. I think it's real, and also return on total assets is pretty good, is very good. I think you can get buried in the minutia. I would want to make sure that, maybe I would be more interested in just the trend if this were dramatically going down. So let's take a look, because I did read somewhere that their profit margins were down ever so slightly. So tiny bit down in 2021. Wouldn't be too worried about that. 74% from 75.6%, 74.2, 75.2 to 74.2. So 1%. But remember, their earnings have been going up dramatically, and that in the end The reason you want good gross profit margins is so that when they turn revenue into earnings and free cash flow, they do it efficiently. So I'm more interested in those numbers than how those numbers are achieved. Okay. I'm going to look. Oh, and so again, gross profit margins up nearly, gross profit margins and revenue up nearly 50% in the last trailing 12 months. 91% of revenue is from subscription-based meals. Their average revenue per coach increased 13% in third quarter 2021, which is the most recent quarter I had data for when I originally did this. Both due to increased clients per coach, so each coach is handling more clients, and increased spending per client. Revenue grew 84%, but we've kind of covered that above. And their new Optavia subscription product increased from the revenue, increased from 83% to 94% of consumable products sold. So Octavia is just growing into their dominant product. Okay, let's look very quickly at VectorVest. Hang on. Okay. And VectorVest is just another service that you can use. I just did the free evaluation. So they're saying that it's a hold right now. It's a good value. It's safe. Overall rating is good. Upside potential is great. The timing is poor. VectorVest really likes to focus on timing, and I'm not a big fan of that because I'm kind of a buy and hold guy. So Medifast has been down for, you can see here in these graphs. And so VectorVest would wait until it's been rising for a while. My thought is, hey, if I think the company's a good buy, I'll buy at least a little bit now while it is down but rising. So I'm going to wait for it to have start rising again. So hopefully it's bottomed out. And then this is zoomed in. And you can see here that VectorVest is saying price right now is 203. Current value is about $311. I don't think it's quite that valuable, but I'm hoping for a 20 or 30% price appreciation. But we'll see what happens. Okay, now some risks. Biggest risk, I think, is Noom's new app-based model. If it's successful, they're going to solve the problem a lot more efficiently than assuming it's effective, assuming they reach economies of scale so they can continue growing after they run out of all their venture capital money. Then there is the risk that they can solve this problem much more efficiently because they don't need to ship meals. Now, I will point out that I think people see value in the meals. I think that there may be a perception on the customer of no price, no value. And you do sometimes run into the problem of what's called price as signal, which is that if something's really, really inexpensive, then people don't value it as much. And the beauty of selling the food is that it feels like you're getting more, you're more financially invested, and that can help you be more psychologically invested. All hypothesis on my part. We'll see what happens. There's also been some insider trading. However, it's been not a whole lot, and it's been bought and sold. People only buy for one reason, because they think it's a good deal. They could sell because they had to put a kid through college or something, and it's not a whole lot. It's been $450,000. So probably not too worried about that. Some questions I had going forward. What's their lifetime customer value, or LTV? What's their churn rate, which is the percentage of customers they lose every year? Because remember, they're moving to subscription-based service. Those are two really easy metrics that give you the health of a subscription business. And I know them from my company. Anybody running a subscription-based service would know them. Okay. So we've got, I haven't covered these in this video, but I'll do it in an update. Earnings per share growth rates vary from about 16% per year to about 24%. The lowest is from SimplyWall.st, which we, I think, covered or will cover in this video. So I'm going to do a worst case scenario and an optimistic case. So worst case is here, which is that I've gone to first FastGraphs. I've put in the low custom growth rate, earnings per share growth rate of 16%. And I'm assuming that it's going to stay around the same PE ratio. So you kind of hard to see this little line here, is dotted black line, but it comes up to here. And that would give us a rate of return of 19.8%. That includes capital appreciation of 164% and dividend appreciation of 17.8%. So mostly from capital, partially from dividend. Okay, so let's look at optimistic scenarios. So if we go back here and we say, okay, we can use 24%. Okay, so if we put in, actually, what I'm going to do is, to make it easy, I'm going to go back to estimates, just plain estimates. And they are going to give me a 21% earnings per share growth rate. I'm not quite sure why that's slightly different than what we saw on the historic, but let's just keep it simple. So 21%, 21 point roughly 5% earnings per share growth. And let's assume that the PE ratio is going to trend more back to 21, that same 21.44%, which would be a PEG, PE to growth ratio of 1, which is kind of just a rough rule of thumb. That's a pretty good PEG ratio. You want your PE to be less than or equal to your growth rate. Okay, so if I take this and I come up to 21.44, okay, now we're looking at, about a 48.59% rate of return. So that would be our relatively optimistic scenario. So that's everything I've got for you. I would love your feedback, questions, anything that you think I've missed. Hit that like button if you want to see more like this, and subscribe to my channel, again, if you want to see more like this. Thanks, it's been fun. Hit that like button so I can reach and help more people. Subscribe for regular updates on stocks I analyze. Click the bell so you don't miss anything.